Welcome to the Calzone, everybody. Ben and Bryan here, back in our studio. Thank you, Ben.
Mm-hmm.
I
got my Hawaiian shirt on today.
You do, dude, and you're making it look really good. I need to get back on that tonal, bro.
Next podcast, I'm coming with a beard and a Hawaiian shirt.
I'm gonna start doing push-ups before I start talking about this thing. Dude, I don't know about you guys, but I'm sure you have, Bryan,
Yep.
but over the last couple of weeks, I have been getting so many calls about these new guidelines for
This right here.
for loans,
Yeah,
right?
I think it was last Thursday or Friday. It hit the national news, and everyone went, "What?"
Right, and I don't necessarily trust the media, right, about anything, and they're making it sound pretty scary. They're like, oh my gosh, we're redistributing, or stealing,
Penalizing, right?
Right.
Using like these big words.
robbing Peter to pay Paul.
Yeah, you're
Yeah.
socializing the program.
Socialism has been a big word in a
Yeah,
lot of
that's
these
a big
articles,
one.
bro.
Yep.
And I am like, hey, what is the story? So, Bryan, I wanted to bring you in, dude, and get to the bottom of this. Yep. Basically, what we are talking about is...
Oh, I think we're going to scratch the surface.
Right.
We're going to be 30,000 feet, okay?
This is going to be super, super quick. But what we're talking about is if your credit score is lower, it might cost you less to get a loan.
Yep.
But if your credit score is higher, it might cost you more to get a loan.
Yep.
How can that possibly be, and what kind of numbers are we talking about?
So I would say it would cost less or more to get an interest rate.
Gotcha.
Compared to where we were, a couple of weeks ago, right? So the FHFA is the company that oversees, and this is only on conventional loans. There are conventional loans, USDA, FHA, VA. This is only on your conventional loans. So that's one thing for everyone that we want to make clear. We're just talking conventional loans here. The financing authority that oversees Fannie Mae and Freddie Mac, they have these tables that we're looking at. And so we went from being a 740 being the prime credit score, and we took it up to 780. The FHFA does this from time to time. This is not, completely out of left field. They did it in 2020. They said, hey, let's make it a little bit tougher for investors to get in, more expensive for investors, and give some incentives and more expensive for second home buyers. Now what they're doing is they're just changing the way that the table works, right? They're going and saying, okay, we're going to start off higher, and there's going to be adjustments to the cost to the interest rate.
Just to kind of like what I saw and like to really dumb it down, right, is there was just a shift, right? It looks like it's all of the same numbers. They just like shifted shifted the sell over.
Yeah. And so, it does have an effect on a person that's a 740 credit score with 5 to 10% down.
Because 740 used to be the base rate. Over 740, it was like, you can't do much better. Right?
Yeah. It was the top that we were looking at.
And now that's 780. So if you have a credit score over 780, not much has changed, right?
If you were a 780 now compared to 6 weeks ago, your interest rate wouldn't have changed at all.
Awesome.
In this scenario.
Cool. Now, most of our buyers are, I don't know, Bryan, from what, 700 to 740? Is that about right?
Yeah. And so those are the people that are having a little bit of a hit to the cost for the interest rate, right? It's about 1/4 to 0.5% on cost, which is, on a $400,000 loan, it's $500 to $1,000? No. $1,000 to $2,000 more for the same rate from a couple of weeks ago. But as rates improve, that gets eaten up into it. So really, the thing that they're saying is that the biggest takeaway, I would say, is they're saying, okay, well, but if you have a lower credit score, you're going to have an easier time getting a conventional loan. Mm-hmm. And at the end of the day, that is true. They did reduce the cost for the interest rate on lower credit scores.
Mm-hmm. I'm going to guess that they're getting it somewhere else, though.
So,
Is that true?
Well, before we jump into that, and,
Yeah.
and we didn't really clarify this beforehand, but in that credit score range, Brian, how many people are going conventional versus FHA?
in which range?
Well, so the range that you're talking about, where we're starting to see an improvement in the redistribution.
So under 680.
Yeah,
The under 6'8", 95% of them are FHA buyers.
Are FHA. So
Yeah, so this doesn't affect them.
it doesn't
at
even
all.
affect them at all. Okay.
Yeah.
Okay.
Yeah, and the
then
FHA
we'll circle back to that because I do want to talk a little bit about, and we talked about talking about, some of the headlines that are hitting the news. But let's finish this thought.
So when you go and you're saying, okay, with a 680 credit score, or 660 is where we ran the numbers. If you have a 660 credit score with 5% down on a $400,000 purchase, the rate cost to get your interest rate is
1.25.
It dropped down.
And that it was 2.75.
So it dropped down 1.5.
So it is cheaper.
It's cheaper to get the interest rate.
Yeah.
Substantially cheaper to get the interest rate on a conventional loan at that credit score.
But but the reason 95% of people went there wasn't necessarily due to that cost. It's because of the mortgage insurance costs.
Yeah.
So when you talk about 660 with a $400,000 purchase price and 5% down, mortgage insurance on that loan, $400 a month.
Which we just talked about as like $50,000 to $60,000 in purchasing power.
Yeah, it's
a lot.
It's a lot.
It's
yeah.
60 to 70. I'd probably even venture.
Get
And
you
so
another bedroom.
right? That's exactly. And so when you go FHA, when you're looking at FHA, not only are you not coming in with the full 5%, you're at 3.5%. Your mortgage insurance drops down to $179 a month
On FHA.
on FHA.
FHA is a fixed mortgage insurance?
Yeah,
Okay.
yeah, and that's the really cool thing with FHA. So not only does the FHFA make changes to conventional loans, the FHA makes changes to their loans. So the mortgage insurance, they just cut by about 30% your monthly cost. So, they were already saying, hey, let's make it easier to get an FHA loan. This doesn't necessarily,
I'm going to go out on a limb here and say that this doesn't really matter for the lower credit score because they're not going to go for this loan type anyways.
Right, you're going to go FHA.
So I think that's a good segue
lower
into
credit score,
But
lower down payment.
This
like
could.
the 5 to 10.
I see where this could come into play if an FHA buyer, or if a buyer with a lower credit score wants a house that wouldn't appraise through with an FHA loan or an FHA appraisal.
Yeah.
Like a flip or something like that a person with a low credit score wants to buy, this might come into play. But
with appraisal issues, right?
Right.
If the person wants to get a condo, if you've got a 660 and you want to buy a condo, that got a lot cheaper, right?
So, hey,
Got it.
So there are
it's
going to be pockets where it makes more sense for one person to go one way than it did a couple of weeks ago. And there are going to be pockets where, like, the argument that, lower credit scores are getting favorable treatment, but we're not going that route, right? We're still going to stick with the FHA because it's hundreds of dollars in mortgage insurance alone. So the real takeaway is who you work with matters. So, you want your people to not necessarily know these, but know that we're going to work the numbers and get them in with as little out of pocket and as low of a payment as possible. And we'll show them what the difference is. We do a presentation with 4 different options that shows, here's if you go conventional at 5% down, here's FHA at 3.5, here's conventional at 10, and so people can really get a feel for this stuff.
right. And like these small ones, like Ben highlights 720 credit score, and then the two like right there. So like if you're putting down 19%, right? You're paying 1.25%, but if you could pay just 1% or 1.5% more for your down, it's only 0.75. So you want to work with a lender who's going to notice that and go, oh man, you are $3,000 away from getting 0.75.
Yeah, so that's
instead of
that's the difference between the 20 and 25% down right there
Right.
that you're talking about. Yeah, and it is kind of funny because we see these and we do figure out how to work them. Like if
Right.
in this same circumstance, if I've got
We
a
didn't
borrower that
mention
wants,
this, but for the layman, right? This is which I am one. This is
said that like
this
you
is
were bragging.
this is in this is in addition to the rate, right? Like this is what we are looking at is the shift, the either like the addition to the going rate that Fannie or Freddie is.
So yeah, this is the
what
cost.
what are we looking at?
This is the change.
because we didn't talk about that,
Right?
right?
Right.
And that's a good question. It's a change to the cost. So whatever the base interest rate is, they're going to show you 6.5% is 99.5, 6.25 is 99.25. That's the pricing based on 100. So then they're going to go, okay, well then you need to charge an extra 1.25 points. So instead of being 99.5, it's 98.25. Really glad I pulled that out. So it took a second. So what you're looking at is, okay, you can come up with that extra 1.25% in cost. So on a $400,000 loan, it's $5,000. You can come up with that extra $5,000, or the interest rate goes from being 6.5 to 7%, or 6.75, 6.875, because you're absorbing that cost into the rate.
Got it.
So, yeah, it's not like a 1-for-1 or anything. That's why, we don't really want to.
So really, in summary, it's not changing that much. It's not as crazy. I'll put it like this: it's not as crazy as some of the article headlines that I've seen out there make it out to be.
Most of these adjustment changes are like 1/4 to 1/8% on your final interest rate. So it might be another $40 to get into a home,
And
a month.
You said these changed in like what, 2020? Is that?
Yeah, so they go into effect. Oh yeah, they changed in 2020. The FHFA came out and said that they were going to make it more expensive for investors and second homeowners because everyone was going out and buying up all the real estate, and first-time home buyers were making 27 offers and not getting them accepted. You know about that. So, that was their way of saying, hey, we're going to make this more expensive for investors so they're not so quick to jump the gun.
My question is this the new normal?
So, I mean,
we can bitch about it all we want, but they're not going to change that back to what it was anytime soon, or are they?
It's basically right. This is FHFA's standard operating procedure. Mm-hmm. This is our new normal right now. Will they go in and tweak it again? Yes. Most certainly they will. One of the things.
Cal, when was the last time you went into a restaurant and got to pay less than you did the time before?
That's what I'm asking, dude. This goes into this rant I went on with Bryan the other day, dude, about me getting gouged everywhere I go, bro. Like that one day that I called you, I was like, I'm about to freak out, dude. I'm just getting gouged everywhere, and I was going to get a bid for I don't know, a wall to get knocked out or something like that, and I told Bryan, I was like, I fully expect this bid to come in at $400,000 just because everybody's gouging me, dude. So I'm wondering if the amount of we'll just call it bitching out there, the amount of complaining that we do, we just got to swallow this, right?
Yeah, I don't. The people that make these decisions, there are ways to frame it that definitely are, like you can see in the mainstream media that say all the things that we talked about them saying. The people that are making the decisions to change these tables, right? Again, I'm always going to say it, much smarter than me.
Right.
Right. Mm-hmm. They work these for a living. They know the numbers behind it. And so they go, okay, well, these are the changes we need to make.
And it's not as bad as
the sky is not falling.
Right. And it's not robbing Peter to pay Paul. Once you look at it and notice that the FHA buyer or the low credit score buyer is going to go FHA anyway.
Yeah.
That's not what it's doing, and I wish these headlines would change that, because that's not at all what this is.
And you know what? The other thing really is the market's been getting better. Rates, like today, I think we were up 30 basis points. So all that means is most of these changes, they just got absorbed into the rate. You know, I mean, you know, we're not getting lower like we'd hoped, right? We're kind of stagnant for a minute, and then rates will get better. But yeah, it is normal, completely normal for this stuff to be happening. And
Well, so just thinking about our solution, I think the solution is, you know, get a loan before the rates go up more.
Lock something in before May 1.
No,
so that's the problem.
Before this stuff goes up more.
So
just going back to your point about getting gouged.
So that's the problem, though, is this is already into effect.
Yeah.
There is no going back to the old stuff because it takes effect May 1, but the securitization process takes weeks. So we had to close loans with the old LLPAs by the 15th. So that's why it kind of became mainstream media news. Like these came out 3.5 months ago.
Right.
You know, so.
And Ben, if you don't have anything, do you have any other questions on this?
I do not.
I did want to tell our audience that this is my 4th conversation about this. And I am finally starting to understand it. And I'm in the business, right? I do this every single day. So if you have questions, or if anybody has any questions, or they read a headline and try to get scared or anything like that, just call one of us, and I'll take you through the 4 conversations that I had.
So much goes into how this works, right?
There's a lot going on.
There's
a lot going on, but I appreciate you working with me, Bryan, and helping me understand it. It's not that crazy.
No.
Radical.
I think I want to fill out a contact form right now. I don't get it.
We'll have 3 more conversations with you, Ben.
There it is.
Awesome. Well, thanks for joining, guys, and that's it.
Cool. Awesome.
Peace.